Well, let's go to that wage growth number that Ed talked about. It was 3.7% for the year. That's the highest in 11 years. It also raises the prospect that inflation might be harder for the Reserve Bank to dislodge, leading to higher interest rates for longer than many expected. Of concern is that public sector wages now appear to be catching up with the trajectory of the private sector. There is something else from today's stats. The number of people getting a pay rise between 4 and 6% is right now soaring. Pay rises above 6% are also on the up, but pay rises between 0 and 3% right now, they're going down and going down fast. Shadow Treasurer Angus Taylor spoke at the National Press Club and rejected the government's budget for creating pressure on inflation and on interest rates.
Now, $1 today is worth less than it was a year ago. $1 today is worth less than it was a year ago. And this government's policies risk inflation and interest rates that are higher for longer, prolonging the pain. Australians trying to get ahead will be the ones who pay the biggest price. The Coalition has been clear that we would not have delivered this budget. Our priority would be to bring down inflation and set up Australia for growth in the medium term through lower taxes and growth-enhancing policies.
So let's analyse this latest wages data with Sean Langcake from Oxford Economics in our Adelaide studio. Sean, always good to chat to you about this. I mean, it doesn't take pressure off the Reserve Bank, does it? Because you can see where the trajectory of those pay rises are going. It's not the end of the story.
Thanks for having me, Ross. Yeah, I agree. Look, wages growth, if anything, it's stepped down a little bit over the last couple of quarters, but it's still uncomfortably higher for the Reserve Bank. And look, I'm not sure that today's data changed too many minds. I think the next few decisions will be very line ball. And if you were of a mindset that the Reserve Bank was done, you probably still believe that. But I still think they've got a bit more heavy lifting to do and rates will be going up at the next meeting.
OK, let's talk about the inflationary impact of the numbers that we saw today. This wage price index, 3.7%. What I notice is the public sector wages are catching up the private sector wages. I know there's also been some enterprise bargaining agreements that have been completed during this period of time, and they obviously are higher than what they'd been previously. This all is starting to just add into that inflation rate, isn't it?
Yeah, absolutely. I think it's worth bearing in mind that the labour market has been in a remarkably tight position for better part of 8 or 9 months now. It's been hovering around 3.5% unemployment rate. And those that are on individual agreements, their wages can respond a little bit more quickly to those very tight market conditions. But those on EBAs and in the public sector, it takes a bit more time for that to filter through to those kind of slower wage reset agreements. So that takes time. That's coming through now. There's also a factor at play here that, you know, a lot of these agreements are linked to the CPI, and we've had a very brisk, very fast inflation for some time now. So that starts to get baked into EBAs and is putting upward pressure on wage rates.
And so this is, we should point out to people, showing you the overall totality of the employed community. But of course, there's also the decision from the Fair Work Commission about the lowest paid and those on award wages, where the government has said it wants inflation, currently 7%. The unions, the ACTU, has said it wants 7%, and the employers are back down in the mid-threes, 3.8%, I think it was, for the Australian Industry Group the other day.
Yeah, I think it's never too surprising to see those parties start at very different starting points for their negotiations. We did see, you know, quite a generous decision from the Fair Work Commission last year, which is, you know, understandable at a point in time where people are facing really strong cost of living pressures. But there is a trade-off there, and it does factor into the costs that businesses are facing and ultimately shows up in inflation. And it's the same juggling act that they'll be faced again this year when they hand down their decision for 1 July. I still think we'll see, you know, an attempt to give people something back to deal with cost of living pressures, but, you know, we may not fully match the CPI rate like we did last year.
One of the interesting parts, and this is where the Reserve Bank starts to think about this as well, is where is full employment in Australia? What's quite clear is we're beyond capacity for employment in Australia. We just don't have the people for the jobs that are required right now at 3.5%. Now, is it 4.25%? Is it 4%? Is it 4.5%? That guessing game also determines where the Reserve Bank is going to move interest rates in the future.
Absolutely. And, you know, after the RBA review, we're going to be having these discussions more frequently because that kind of thinking is going to be enshrined in how they go about things. they'd be the first to point out that, it's hugely uncertain as to exactly where it sits, but I think there's no argument that we are beyond full capacity at the moment. And what we mean when we say that is that, we're at a point with the labour market where it's generating wage growth that's faster than what will generate an inflation rate consistent with the RBA's target. The missing piece in that puzzle, of course, is where productivity growth is, and certainly the RBA's shifted the conversation there a bit more recently. We're going to need the national accounts to have a bit more light shed on that right now, but I do think that today's print will be, uncomfortably high for the RBA and prompt a bit more action from them.
Okay, so there's a couple of things that also feed into the Reserve Bank and its next decision. One of those is going to be the labour force numbers that come out tomorrow, and the market is expecting an unemployment rate of 3.5%. Is that where you've got it? And does ultimately that unemployment rate naturally have to start to rise as we get more immigration?
I'm not sure it has to rise with more migration because, that's in addition to both labour demand and supply. I do agree that, we're likely to see a number pretty close to 3.5%. Any deviation from there, we'll probably look through that in considering what the RBA will do because they won't want to be too responsive to 1 month worth of data. The headline there is that the market is certainly beyond, conventional estimates of where full employment is. And I agree. I mean, they are trying to engineer a kind of a slow upward drift in the unemployment rate. They see that as a necessary condition to bring wage and inflation pressures back in check. The million-dollar question here is how quickly do the Reserve Bank want to see inflation fall? And here, I think their communications have been, a little bit muddled. At one point in time, it seems they're content with inflation on a course that doesn't get back to 3% until mid-2025, in line with their forecasts. At other times, we get the impression that they'd like to see it come down quicker than that.
Yeah, I tell you what, Sean Langcake, great to have you on the program today. Many thanks for input. So you heard there, one more rate rise from the Reserve Bank, he says.